And I'm going to tell you something right now that your financial advisor doesn't want you to hear. If you have $10,000 sitting in a bank account today, listening to me right now, you are making a catastrophic mistake. I'm not guessing, I'm not hoping. I'm telling you, based on 40 years of investing experience and billions of dollars in transactions, that the way you think about $10,000 in 2026 is completely wrong. Here's the reality: the average American holds over $9,000 in cash, earning 0.01% interest. 0.01. That's not investing, that's financial self destruction. And with inflation running at a persistent 3 to 4%, that $10,000 loses $400 of purchasing power every single year. You're getting poorer while doing nothing wrong. That's the tragedy I'm here to fix. In the next 24 minutes, I'm going to give you my personal blueprint for exactly what I would do if I had $10,000 to invest in 2026. Not theoretical advice, not generic diversify your portfolio nonsense. I'm going to give you specific numbers, specific strategies that I'm using myself and recommending to the institutional investors I work with. I'm going to break this down into 5 specific moves, 5 places I put that money right now. Some of them will surprise you. Some of them go against everything the talking heads on television are telling you, but I don't care what they're saying. I care about what the data is screaming at us. And the data is screaming that 2026 is going to be a year that separates the investors from the gamblers. Are you ready? Let's get started. Now, before I give you the 5 specific places I put $10,000 in 2026, I need you to understand something important. I'm not some talking head on YouTube who's never actually built anything. I've been investing for over 40 years. I started my first company with a $10,000 loan from my mother. True story. And I built that company into a software business that I eventually sold for $4.2 billion. That's billion with a B. I've been through 7 bear markets. I've survived the dot-com crash, 9/11s, the 2008 financial crisis, COVID, and the inflation spike we just lived through. And in every single one of those moments, I saw the same pattern. Regular people with good intentions making the exact same mistakes with their money. And I'm telling you right now, 2026 is shaping up to be one of those dangerous years where the gap between the wealthy and everyone else gets blown wide open. Why do I say that? Let me show you what the data is telling me. Right now, we have a perfect storm forming. The Federal Reserve has signaled they're done cutting rates for the moment. The bond market is flashing warning signs I haven't seen since 2007. Corporate earnings are slowing, and yet individual investors are piling into the same speculative garbage that destroyed portfolios in 2020. Here's a number that keeps me up at night. According to Vanguard, the average retail investor underperformed the S&P 500 by nearly 4% annually over the last 20 years. 4%. Do you understand what that means? If you had invested $10,000 in the S&P 500 in 2004 and just left it alone, you'd have roughly $62,000 today. But the average investor jumping in and out, chasing hot tips, trying to time the market, they ended up with just $38,000. That's $24,000 left on the table. For what? For the illusion of being smart, for the thrill of gambling instead of investing. I'm not here to give you thrills. I'm here to give you the truth. And the truth is 2026 is going to punish people who don't understand what's really happening in the economy. We're entering a period of what I call capital discipline. Money's no longer free. Interest rates are normalizing after 15 years of near zero insanity. Companies that survive don't cheat. Debt are going to start failing. Dividends are going to get cut. And the investors who don't see this coming are going to get slaughtered. But here's the good news. You're watching this video right now. That means you have the opportunity to position yourself correctly before the damage happens. That's what I do. I don't try to predict the future. That's a fool's game. But I read the data, I understand the trends, and I position my capital to survive whatever comes next. So here's what I'm going to do for you today. I'm going to take that $10,000, whether you have it in cash right now, whether you're just starting to invest, or whether you're looking to reallocate an existing portfolio, and I'm going to show you exactly how I would deploy it in 2026. This isn't a get-rich-quick scheme. This isn't crypto nonsense. This is old school, boring, proven wealth building that has worked for centuries and will work for centuries more. Let me start with the first place I put that money. And this is going to surprise you. Here's where I'd put the first $2,000 of that $10,000. And I guarantee you're going to think I've lost my mind. I'd put it in a high-yield savings account. Wait, Kevin, you just spent the last 2 minutes telling me cash is trash, and now you want me to put money in savings. Let me explain. Because this is where the sophisticated investor separates from the amateur. I'm not telling you to keep all your money in cash. I'm telling you that in 2026, having zero cash is just as dangerous as having all cash. You need dry powder. You need liquidity. You need the ability to act when opportunity knocks. And believe me, opportunities want to knock in 2026. Here's what the data tells me. Right now, you can get a high yield savings account paying 4.5 to 5%. That's not nothing. That's actually a respectable return for zero risk. But more importantly, that cash gives you something no stock can give you, optionality. Let me give you a real example from my own portfolio. In March 2020, when COVID hit and the market cratered 34% in 5 weeks, I had $150 million in cash sitting on the sidelines. Everyone thought I was crazy. Kevin, you're missing the rally. Kevin, you're losing to inflation. I didn't care. I knew what was coming. And when the market hit bottom, when companies I've been watching for years were trading at 50% discounts, I deployed that cash over a 72-hour period and bought positions I still hold today. That cash didn't earn much interest while it was sitting there, but it gave me the ability to buy when everyone else was forced to sell. That's the power of liquidity. Now, I'm not telling you to keep $150 million in cash, but I am telling you that $2,000 of your $10,000 should be in something you can access within 24 hours without penalty. Why? Because 2026 is going to have moments of panic. The market is going to overreact to something, a geopolitical event, a bad jobs report, a corporate bankruptcy. And when it does, you want to be a buyer, not a seller. Here's the second reason I keep cash. Life happens. Your car breaks down. You lose your job. Your kid needs braces. If your entire $10,000 is tied up in the stock market and you need money fast, you're going to sell at exactly the wrong time. I've seen this destroy more portfolios than bad stock picks. The numbers don't lie. According to a study by JP Morgan, the average investor's returns are reduced by nearly 2% annually simply because they're forced to sell during downturns to meet cash needs. 2% over 30 years. That's the difference between retiring comfortably and running out of money at age 80. So where do I put this cash? I'm not going to give you a specific bank because rates change daily, but here's what I look for. FDIC insured, minimum 4.5% yield, no monthly fees, and the ability to transfer money same day. Companies like Ali, Marcus by Goldman Sachs, CIT Bank, these are the names I use. Do your own homework, but those are the standards. Now, I can hear the skeptics already. Kevin, 4.5% is nothing. I can make 20% in crypto. I can double my money in options. Listen to me carefully. That's not investing. That's gambling. And if you want to gamble, go to Las Vegas. At least they give you free drinks. The foundation of wealth is not losing money. The first rule of my investment philosophy, and I've said this for 40 years, is capital preservation. Before you can grow wealth, you must protect wealth. At $2,000 in cash, that's your wealth protector. That's your insurance policy. That's your ammunition. But here's what concerns me even more. While you're sitting on that cash earning 4.5%, I'm watching something in the bond market that has me genuinely worried. And if you don't understand what's happening there, you're going to make a mistake with the rest of your money. Now, let me tell you where I put the next $2,000, and this is going to make some of you uncomfortable. I'm putting it in short-term treasury bonds. I can already hear the young investors screaming, bonds, Kevin. Bonds are for all people. Bonds are for retirees. I want growth. Listen to me. Stop listening to TikTok influencers and start listening to the data. Here's what's happening in the bond market right now that almost nobody is talking about. The yield curve has been inverted for the longest stretch in history. For those of you who don't know what that means, and you should, an inverted yield curve is when short-term bonds pay higher interest than long-term bonds. Normally, you get paid more for lending your money for longer periods. That's how risk works.
But right now, the opposite is true.
Why does this matter? Because every single recession in the last 50 years was preceded by an inverted yield curve. Every single one. I'm not predicting a recession. I'm telling you what the data shows. And in 2026, that inversion is finally starting to normalize, which historically happens right before economic trouble. So what do? I buy short-term treasuries. Right now, you can get 2-year treasury notes yielding around 4.3%, completely backed by the full faith and credit of the United States government. That's not sexy. That's not exciting, but it's safe. It's liquid, and it's paying me while I wait to see what happens. Here's a specific ETF I own personally. The iShares 13-year treasury bond ETF. It holds treasuries with maturities between 1 and 3 years. It pays a monthly dividend, and it trades like a stock in 2026. When uncertainty is high, I want that kind of liquidity and safety. But Kevin, you say inflation is still running at 3%, so I'm only making 1.3% real return. You're right, but here's what you're missing. The purpose of this money isn't growth. The purpose is stability and optionality. If the economy slows down and the Fed cuts rates, which they will if we enter a recession, these bond prices will actually go up. You get the yield plus price appreciation. That's what we call a double play. Now, let me give you a real example from my career. In 2007, before the financial crisis, I started moving money into short-term treasuries. Everyone thought I was crazy. Kevin, the stock market is booming. Kevin, real estate is going to the moon. I didn't care. I looked at the yield curve. I looked at the housing data, and I saw trouble coming. When the crisis hit in 2008, my treasury portfolio not only held its value, it actually increased as investors fled to safety. And more importantly, I had liquid capital to buy stocks when they were down 50%. That's how wealth is built, not by being right all the time, but by being G positioned to survive the times you're wrong. Here's the number you need to remember. During the 2008 crisis, the S&P 500 lost 38%. Long-term bonds gained over 20%. The investors who had both didn't just survive, they thrived. That's called diversification. And it's the only free lunch in finance. So for 2026, I'm telling you to put $2,000 of that $10,000 into short-term treasuries, whether you buy them directly from treasurydirect.gov or through an ETF like SHI or BLL. You're building a foundation that can withstand whatever the economy throws at us. But here's what concerns me even more. While everyone's chasing the next hot stock, they're completely ignoring the single most powerful wealth building tool in the market right now. And I'm going to show you exactly what that is. Now we're getting to the interesting part. Here's where I put the next $2,000. And this is where the real wealth building begins. I'm buying dividend paying stocks, but not just any dividend stocks, I'm buying what I call dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. These are the gold standard of income investing. And in 2026, they're going to outperform everything else. Let me explain why this matters. Right now, we're entering an era of what I call income scarcity. For 15 years, from 2008 to 2023, you couldn't get a decent yield on anything. Bonds paid nothing. Savings accounts paid nothing. Investors were forced into risky assets just to generate any income at all. That era is over. Right now, you can get a 3, 4, even 5% dividend yield from some of the strongest companies in America, companies that have been paying dividends for decades, companies that have raised those dividends through wars, recessions, and pandemics, companies like Procter and Gamble, Johnson & Johnson, Coca-Cola, and Lowe's. But here's where most investors get this completely wrong. They look at dividend yield alone. They see a stock paying 8% and they think, wow, free money. No, that's not investing. That's a trap. Let me teach you something important. When you see a dividend yield that's significantly higher than the company's historical average, that's not an opportunity. That's a warning sign. It usually means the stock price has collapsed because the market expects the dividend to be cut. And when dividends get cut, the stock gets destroyed. I learned this lesson the hard way early in my career. I bought a utility company yielding 7%, looked amazing on paper 6 months later. They cut the dividend by 50%. And the stock dropped 40% overnight. I lost money and lost income. That's the worst of both worlds. So how do I do it right? Here's my system. First, I look for companies in the S&P 500 Dividend Aristocrats Index. These are companies that have raised dividends for at least 25 straight years. That track record tells me management is disciplined, the business model is durable, and shareholder returns are a priority. Second, I look at payout ratio. That's the percentage of earnings paid out as dividends. I want to see 60% or less. Anything higher than that, and the dividend is at risk if earnings dip even slightly. Third, I look at free cash flow. Earnings can be manipulated. Cash cannot. I want companies generating enough cash to cover the dividend multiple times over. Here's a specific example I own personally. Procter & Gamble, ticker PG. They've paid dividends for 132 consecutive years and increased them for 67 years. That means through the Great Depression, World War II, the 1970s stagflation, the 2008 crisis, and COVID, PG kept raising their dividend. Today, they yield about 2.5% with a payout ratio under 60% and massive free cash flow. Another one I like right now is Lowe. We ticker Lowe. They're a dividend aristocrat with 60 plus years of increases yielding around 2%. But here's the kicker. They've been growing earnings at 15 to 20% annually. You get income and growth. That's the sweet spot. Now, here's my ETF solution. If you don't want to pick individual stocks, no BL, the ProShares S&P 500 Dividend Aristocrats ETF. It holds all the dividend aristocrats in one basket, pays a monthly dividend, and has extremely low expenses. In 2026, with all the uncertainty we're facing, I'd rather own the basket than try to pick the winners. But here's what really excites me about the strategy. When the market gets rocky, and it will in 2026, dividend stocks tend to hold up better than growth stocks. Why? Because income investors are sticky. They buy and hold for the cash flow, not for price appreciation. That creates a floor under the stock that growth stocks don't have. Let me give you the numbers. During the 2022 bear market, the S&P 500 dropped 19%. The Dividend Aristocrats Index dropped only 12%. That's 7% less pain. And when the market recovered, they participated in the upside too. That's what I call asymmetric risk. Less downside, same upside. So for $2,000 of your money, I'm building a dividend growth machine that will pay you cash every single quarter, increase that cash over time, and protect you when the market gets ugly. But I don't stop there, because while dividends are great, there's another strategy I'm using in 2026 that's even more powerful, and it involves something most retail investors completely ignore. Here's where I'd put the next $2,000, and this is the core of my 2026 strategy. I'm putting it in a low-cost S&P 500 index fund. I know that sounds boring. That sounds like what every financial advisor tells you, but there's a reason every financial advisor tells you this, because it works. And in 2026, with all the noise and volatility we're going to see, owning the entire market is the smartest thing you can do. Let me share something with you that most people don't know. I've been investing for over 40 years. I've made billions of dollars in private deals, public stocks, bonds, and businesses. And do you know what the single best investment I've ever made is? Not some hot tech stock, not some private startup. It's the S&P 500 index fund I bought in 1982 and never sold. Here's the math. In 1982, I put $10,000 into an S&P 500 index fund. I didn't touch it. I didn't trade it. I didn't try to time it. I just let it compound. That $10,000 today is worth over $1.2 million. That's not leverage. That's not leverage. That's not options. That's not crypto. That's just America doing what America does, growing over time. Now, 2026 is going to test people's resolve. We're going to have days when the market drops 2 or 3%. We're going to have headlines that make you want to sell everything and hide in cash. And when that happens, the people who own the index are going to be tempted to make the biggest mistake of their investing lives. Let me show you why owning the index is so powerful right now. The S&P 500 has delivered an average annual return of approximately 10% since its inception. But here's what the data really shows, and this is critical. If you missed just the 10 best days in the market over the last 30 years, your annual return dropped from 9.7% to 5.4%. You cut your returns nearly in half by missing just 10 days out of 7,500. And here's the killer. Those best days almost always happen during bear markets. They happen when things look darkest. They happen when everyone has given up and sold. If you're out of the market trying to time your entry, you will miss them. I guarantee it. So which index fund do I buy? I'm a fan of VO, the Vanguard S&P 500 ETF expense ratio, 0.03%. That means for every $10, you invest, you pay $3 a year in fees. $3. Compare that to the average actively managed mutual fund charging 1%, $100 a year on that same $10,000. Over 30 years, that fee difference cost you over $15,000 in lost compounding. Another option is SPI, the original SPDR S&P 500 ETF. Slightly higher expense ratio, but more liquidity. Or IVV from my BlackRock. They're all essentially the same. Pick one with the lowest fee and stick with it. Now, here's my specific strategy for 2026. I'm not buying this $2,000 all at once. I'm dollar cost averaging. I'm putting $500 in every month for the next 4 months. Why? Because valuation matters. And right now, the market isn't cheap. The S&P 500 is trading at about 22 times forward earnings. The historical average is closer to 16 or 17. That doesn't mean we're going to crash. It means we're vulnerable to bad news. By spreading out my purchases, I reduce the risk of buying at the exact peak. But here's what I want you to understand. Over 20 years, the difference between buying at the peak and buying at the trough is negligible. Seriously, study after study shows that investors who try to time the market consistently underperform those who just buy and hold. The only people who get rich from market timing are the ones selling newsletters and trading courses. So for 2026, I'm keeping it simple. I'm buying VO. I'm buying it consistently, and I'm never selling. That's how wealth is built. But I'm not done yet, because while the S&P 500 is great, there's another market that's going to outperform in 2026, and almost no one is talking about it. Here's where I put the final $2,000. And this is going to surprise you. I'm putting it in international developed markets, specifically Japan and Europe. I can already hear the objections, Kevin. International has underperformed the U.S. for 15 years. Why would I throw money away on that? Listen to M. E carefully. The biggest mistake investors make is assuming the past 15 years will repeat for the next 15 years. That's not investing. That's recency bias, and it will destroy your wealth. Let me show you what the data is telling me right now. The U.S. market has outperformed international markets by a staggering margin since 2009. The S&P 500 is up over 400% since the financial crisis. International developed markets up about 100%. The gap is historically unprecedented, and when gaps get this wide, they tend to close. But it's not just valuation. Look at what's actually happening in these economies. Japan is finally emerging from 30 years of deflation. Wages are rising. Corporate governance reforms are forcing Japanese companies to actually return capital to shareholders instead of hoarding cash on balance sheets. The Tokyo Stock Exchange is literally naming and shaming companies with price to book ratios below one, forcing them to either improve performance or get delisted. Here's a specific ETF I own, DXJ, the Wisdom Tree Japan Hedge Equity Fund. It invests in Japanese stocks but hedges out the currency risk. Why does that matter? Because if the yen strengthens against the dollar, which I believe it will as Japanese interest rates eventually rise, an unhedged Japanese fund would lose value. DXJ eliminates that risk. Now, let's talk about Europe. Everyone hates Europe. The economy is stagnant. Demographics are terrible. Bureaucracy is overwhelming. I know all of this, but here's what the pessimists are missing. European stocks are trading at 12 to 13 times earnings, while US stocks are at 22 times. That's a massive discount. And here's the kicker. Many European companies generate most of their revenue globally. Companies like LVMH, SAP, ASML, Novo Nordisk. These are world-class businesses trading at discount prices simply because they're listed in Europe. My favorite WY, A to play this is VGK, the Vanguard FTSE Europe ETF. It holds over 500 European stocks, expense ratio of 0.08% 0B and 0% 0P, and it yields around 3%. You're getting diversification, income, and valuation all in one package. But Kevin, you say, what about emerging markets? What about China? I'm avoiding them in 2026. Too much geopolitical risk, too much regulatory uncertainty, too much currency volatility. I want developed markets with strong legal systems and predictable governments. Japan and Europe fit that bill perfectly. Here's the portfolio theory reason for this allocation. The correlation between US and international stocks is about 0.88, meaning they generally move in the same direction, but not always. When you add international exposure, you reduce your overall portfolio volatility without sacrificing long-term returns. That's diversification working exactly as intended. Let me give you a real example. In the 2000s, when the US market was flat for a decade, international markets boomed. The MCF index developed international returned over 5% annually, while the S&P 500 was negative. Investors with global portfolios slept much better than those who bet everything on America. Now, I'm not saying America is doomed. I'm saying that in 2026, with U.S. valuations stretched and international valuations attractive, the smart money is going to look overseas. Not all of it, just a piece. That's what this $2,000 represents. A hedge, a diversifier, a bet that the rest of the world isn't as hopeless as the headlines suggest. So let me recap where we are with your $10,000. $2,000 in high yield savings, liquidity, and dry powder. $2,000 in short-term treasuries, safety, and yield. $2,000 in dividend aristocrats income and stability. $2,000 in S&P 500 index growth and simplicity. $2,000 in the national developed markets, diversification, and value. That's the Kevin Oley 2026 block you print. But I'm not done yet, because now I need to tell you what I'm doing with my own money right now. And it might surprise you. Now, I'm going to tell you something that might surprise you. After all this talk about savings accounts, treasuries, dividends, and ETFs, here's what I'm actually doing with my own fresh money in 2026. I'm buying private businesses. That's right. While everyone else is obsessing over stock prices and Fed meetings, I'm looking for something that has built more wealth in human history than any stock market: ownership of private cash flowing businesses. Let me explain why this matters for you. Even if you don't have millions to invest in private deals, the public markets have become completely disconnected from business reality. Stock prices move 5% on a single tweet. Companies are valued on AI hype rather than earnings. Quarterly earnings calls have become theater. I've been doing this for 40 years, and I've never seen anything like it. But private businesses, they don't care about the Fed. They don't care about Elon Musk's latest tweet. They care about customers, payroll, and cash flow. And right now, there are thousands of amazing small businesses owned by baby boomers who want to retire. Here's a statistic that blows my mind. Over the next 10 years, an estimated $10 trillion in business wealth will transfer from boomers to the next generation. 10 trillion. And most of these businesses don't have family members who want to take over. That means opportunity. Now, I know what you're thinking, Kevin. I don't have millions to buy a business. What can I do? Here's your answer. Crowd-funded private equity platforms like Fundrise, Yield Street, and several others now allow regular investors to put as little as $1,000 into private businesses and real estate. You're not buying the whole company. You're buying a piece alongside professional loan. Paraders who do this for a living. Let me give you a specific example from my own portfolio. I've been investing in self-storage facilities through a private fund for the last 3 years. These are boring cash flowing assets that generate 8 to 12% annual returns, regardless of what the stock market does. People always need storage. recession or boom, the checks keep coming. Another area I'm watching closely is healthcare services, dental practices, veterinary clinics, physical therapy centers. These are recession resistant businesses with predictable cash flows. Private equity firms have been buying them up for years, but now platforms are opening these deals to smaller investors. Here's my warning about this space, though. Not all crowdfunding platforms are created equal. Some charge outrageous fees, some make loans that will never get repaid, some are just outright scams. You need to do your homework. Here's what I look for. First, track record. How long has the platform been operating? What have their actual realized returns been? Not projected actual. Second, fees. You should never pay more than 2% in annual management fees plus 20% of profits. That's the industry standard. Anything higher, and the math doesn't work. Third, liquidity. Private investments are illiquid. You cannot sell them tomorrow if you need cash. That's why I still keep that $2,000 in savings. So my private money can stay private. Now, let me be clear. If you don't want to deal with private investments, the 5-part portfolio I gave you earlier will serve you well. It's simple, it's diversified, and it will compound nicely over time. But if you want to invest like I do, if you want to build real lasting wealth, you need to understand that the biggest opportunities are often found where the crowd isn't looking. We've covered a lot of ground in the last 24 minutes. Let me bring this all together. So why? I'll leave with a clear, actionable plan. Here's what I want you to remember about investing $10,000 in 2026. Rule number one, cash is not trash, it's ammunition. That $2,000 in high yield savings isn't earning zero anymore. It's earning 4 to 5% while giving you the ability to buy when everyone else is panicking. In 2026, the people with dry powder will win. Rule number two, bonds are back. For 15 years, bonds were useless. That's over. Short-term treasuries at 4% are a legitimate asset class. Again, they provide safety, income, and downside protection when stocks get ugly. Rule number three, dividends matter more than ever. In a world of uncertainty, getting paid in cash every quarter changes everything. Dividend aristocrats with 25 plus years of increases are the bedrock of long-term wealth. Buy them, reinvest the dividends, and watch compounding work its magic. Rule number four, never bet against America, but don't bet only on America. The S&P 500 is the greatest wealth building machine in history. Own it consistently, own it forever, and never try to time it. But add international exposure when valuations make sense, because today they make sense. Rule number five, think like an owner, not a trader. Whether you're buying ETFs or private businesses, the goal is the same. Own productive assets that generate cash flow. Traders gamble, owners prosper, be an owner. Now, I want to leave you with one final thought. The difference between wealthy people and everyone else isn't intelligence. It isn't luck. It isn't even income. It's discipline. It's the ability to stick to a plan when everything around you is screaming to do something different. In 2026, there will be moments when this plan feels wrong. When the market is roaring and your cash position feels stupid, when international stocks are lagging and you want to sell, when some crypto bro tells you you're missy, NG the next 100x coin, ignore them. Stick to the plan. I've been doing this for 40 years. I've made every mistake you can make with money. I've lost millions on bad bets. And the only thing that saved me, the only thing that built my wealth was discipline. Boring, unsexy, consistent discipline. So here's my challenge to you. Take this video, watch it again if you need to, and write down your plan. Not someday today, not when you feel like it right now. $10,000 invested wisely in 2026 can be $100,000 in 20 years. That's not hype, that's math. I'm Kevin Uller. This has been Mr. Wonderful. Now go build your wealth.